Hello traders, James Stanley with StoneX and FOREX.com. Wanted to look at the US dollar as we go into Fed week. It was a strong week and a half in the USD following the pullback on the CPI and PPI data, but there's still expectation that the Fed will hike in the second half of this year or later this year, and that's helped to keep the dollar bid, particularly as we've seen Japanese yen weakness and, as of last week, euro weakness. Want to look at this from a few different perspectives. First, need to look at a risk disclaimer. I'm going to leave that up for 15 seconds up front, 45 seconds on the back, and it will be in the description field of this video. Please review that, pause the video, take more time to review that if you so need. I will be on the other side and we'll start looking at charts. All right, as mentioned, we have a couple of big items for next week. I wanted to look at the calendar first. The big one, of course, is the FOMC rate decision on Wednesday. Now, it was the rate decision in June that started the rally in the USD, which has continued in through this week's continuation run. And this one's a little different. It's not a quarterly rate decision, so we're not getting updated guidance and projections, but we are still getting a feel for Kevin Warsh, who so far has probably sounded more hawkish than what markets were anticipating, given President Trump's lead-in to choosing who was going to run the Fed. And this, I think, is going to have a pretty big toll on the dollar. But there's another matter to consider, and that's the BoJ rate decision that's coming in after that. Now, at this point, the BoJ is not expected to hike, but it's that yen weakness, that profound yen weakness, that has helped to keep the dollar very strong. The Japanese yen's 13.6% of the DXY basket. It's the second largest component, and we've seen over the past 5 years, I think it has an even larger impact on DXY direction than that 13.6% allocation would suggest. But I'll look at that here in a moment. We also get core PCE data on Thursday, so a day after the Fed. This, of course, is going to be meaningful because this speaks to U.S. inflation. And then on that topic of inflation, we get European CPI on Friday morning. I think this is also going to have a big role, but I don't want to get too deep into projecting how that might impact price action because we have a literal minefield to get through before we even get to that. So Fed, BoJ, I think are the two most important items for next week. We also do have a BOE rate decision on Thursday morning, but the Fed and BoJ, I think those are the bigger macro items. And then that European CPI, US core PCE, and BOE are all high impact, possibly meaningful as well. Now, from a price action perspective, the dollar is still in a bullish spot. This is very much like I had looked at last week after the CPI report, but before the PPI report. At the time, we had this beautiful bullish breakout. Like I said, this triggered at the last FOMC rate decision on June 17th. That's when we got the rally beginning that eventually broke through resistance and ran up to this next high at the Fibonacci level of 101.80. The pullback of that was pretty moderate. And when I had looked at this in the webinar, we were right up here. We had the CPI data. And like I had pointed out, we had these undersides on the daily, these underside wicks on the daily. So you could see where bulls were responding. They just weren't able to get very far. And so when you get that, it's kind of like the move's still a little bit one-sided. You need to see some of those weak hands stopped out. And that's what happened a day later on that PPI data, where we got the break of that support. Those stops that were holding right underneath those lows, they got hit. And then we tested support at prior resistance, the same level that brought the double top back in November. And then that's where bulls stood up into Thursday, into Friday. Now, as we came into this week, it was still somewhat uncertain because you could see where that resistance was holding from around prior support. But this week is where that throttle really got hit with an extra catalyst on Thursday. That Thursday drive was largely coming from the European Central Bank. We'll look at that in a moment in Eurodollar. But at this stage, we have a bullish long-term trend in the dollar. We have a bull flag breakout. We have a fresh near-term high, not yet a big picture high. That 101.80 is the next level up. As I looked at in this week's webinar, I don't like chasing fresh breakouts. I'm willing to miss a setup or opportunity. I would much rather miss an opportunity or a setup than chase a suboptimal setup and take a larger loss or to lose capital. If anything, I'll wait for a pullback to see if support shows up. There's this prior area of resistance right here, like 101.20. That's a spot that hasn't yet been tested for support. I mean, you can see where we've been, kind of gyrating here ever since the breakout after ECB yesterday. But, similar to that setup from last week, if we see those lows get taken out, if we see those stops get taken out, want to see buyers come in to defend that level right around that 101.20. If they don't, no big deal. It's still a bullish trend. Just try to wait and look for a deeper pullback. And you got a level like this, like 101.99 or 100 spot 99. Let's call it 101. Prior resistance, quick hit of support. I'm going to call that my short-term S2 for next week. S3 right in here at like 100 spot 86. That's very nearby. So, maybe you want to put this whole thing as a zone and then instead look down here for an S3 at like 100 spot 65. I'm not going to consider this invalidated until we take out this zone. And that runs between that 100 spot 36 that came into play last November as the double top and these higher lows that had developed after the PPI report last week. But strong near-term bullish trend in the direction of the bigger picture bullish trend, bull flag breakout. There's a lot to like here. But as usual, it's the dollar. We got to look at this for what it is. It's not trading in a vacuum. Whether or not that run can continue, it's going to be dependent on whether the components in the dollar basket can see weakness. The big one there is the Japanese yen. Of course, we have a BoJ rate decision next week. Now, the BoJ is not expected to hike next week. But given how the yen has just melted down, I think it would be silly for Ueda to not at least try to stem the flow a bit. So the BoJ is in a really tough spot here. And I know I see this on social media when I make a tweet about dollar yen, at least until this breakout. But I remember, I think it was like last week, I tweeted something and somebody said, well, Japanese policymakers don't want to see the yen melt down even more because it puts the pension in a precarious spot. And there are all these reasons, all these well thought out reasons. And sure, yeah, maybe they make sense. Maybe that is true. But the reality is this is a going rate in a fair market. And the one thing that has kept this from absolutely melting down is that threat of intervention. That's it. If Japanese policymakers, the BoJ did want to fix this, they could by narrowing the rate differential between these two economies. But that brings with it risk. That brings with it consequence. And I wrote this in an article earlier in the week. I'll try to link it in the description. But that's obviously a set of consequences that the BoJ has not wanted to encounter. They don't want to risk blowing up their growth. Because when you have an aging population, when you have a history with deflation and disinflation as Japan has, that's kind of like dancing with the devil. I don't think they want to do that. Which, case in point, you look at the chart, there's a reason that this is up and to the right. Now, when we do get these counter trend themes, like we had one back here in 22, we had one here in 24, it hasn't really been driven by Japan. It's been driven by U.S. fundamentals. Like, for instance, the BoJ intervened here, and that just paused the move. What finally reversed that was below expected U.S. CPI. 2024, that's as markets were getting ready for the Fed to cut rates. And oh, by the way, when they started cutting rates right here, the pair had already bottomed. Last year, Trump was heavy on the rate cut theme. And you can see dollar yen pricing that into a degree. But that fundamental divergence, that fundamental drive has remained bullish and long to upside, which is one of the reasons that this thing has just continued to tear away. Ever since Takeichi's win in October, when we broke above 150, this has very much been a decisive bullish trend. That said, just chasing blindly, not a wise way to go about trading strategy. So if we do get that perfect backdrop where maybe the Fed doesn't sound as hawkish, or Warsh rather, doesn't sound as hawkish as what many are expecting on Wednesday, and then the BoJ sounds a little bit more hawkish than what is showing right now in expectations given the dollar yen spot rate, that 162.95 level jumps out as important. This was resistance on a couple of different cases. It helped to build a beautiful ascending triangle formation. Hasn't yet shown up as support since the breakout. But if we do get a pullback, that's like the first area to look for a moment of truth to play. I know it's kind of far away, but prior resistance hasn't yet come back into play as support. And like I said a little earlier, I'd much rather miss a setup and trying to be patient than take a larger amount of risk or to miss a setup because my emotions got the best of me, because my excitement got the best of me. I'll wait, and if that pullback doesn't play, so be it. I'll look for it elsewhere. In the yen video earlier this week, like I looked at, there's euro yen, there's pound yen. Those both could have something to work with on that theme. Below 162.95, 160.64 is meaningful. Swing high, resistance, support. So this has been well tested from the market. The challenge that I have with that is if we get all the way down there, it's going to feel like something has changed, or maybe there was an intervention or something along those lines. And so you got to kind of keep open to the possibility of, what created that scenario, and am I still going to want it if that plays, if that happens? And I don't know that I will. But going a little bit deeper, if we look at that ascending triangle that had set up, there is a level down here that I think is also justifiable to look for follow-through support in that kind of picture-perfect scenario where Oeda sounds a little bit more hawkish and the Fed a little bit more dovish. It's like 161.81. So I look at that as like an S1, that is like an S2, and then S3 invalidation right down here, 160 to 160.64. If something breaks there, something has shifted, something's changed. I don't want to be sticking around with risk to find out what it might be. But a couple of important levels here in dollar yen. For next levels up, 165, I would be super surprised if we get to 165 and we don't hear some veiled threats, at a minimum veiled threats, or maybe even direct threats from the finance minister, Katayama. But that's what I'm looking at there. Euro dollar, as we came into this week for the StoneX video, I had said I thought this was going to be the drive point in the DXY basket, and so far it has been. We, again, another bearish technical picture in here where we have a bearish trend with fresh lows that are printed in June. Beautiful continuation. There's that Fed rate decision on June 17. Beautiful continuation thereafter. But you can almost see where the counter trend gyration is very similar to what had led into that. So this is something that, if we do hear Warsh holding the line, sounding like an inflation hawk, this is something that could sync fairly well with what had set up there. Around ECB, Lagarde did not sound all that ready to be hiking rates anytime soon, and that's one of the reasons that we got the break of the bear flag formation, why we got the bearish engulf. So, at this point, like the mirror image of the dollar, this is a bearish setup from a few different perspectives, right? Like bear flag break, bearish engulf. Even on a shorter-term basis, the pullback this morning saw sellers jump in for resistance at prior support. So far this morning, or in Friday, ahead of the weekend, ahead of the weekly close, we've heard some of these ECB members maybe sounding a little bit more hawkish than what Lagarde had come off as yesterday, and I think that's one of the reasons that we have this gyration in here. But, like I was saying and looking at the calendar, before we get to that CPI print, we have a veritable minefield of drivers to go through. So it's the way that those play that's going to determine how this is going to get absorbed. I think, again, going to that ideal scenario that I was looking at on the yen, where maybe we hear the Fed is a little bit more dovish than what many are expecting, and Wade is a little bit more hawkish. If we get that, I think it could justify dollar weakness, pullback in dollar and euro dollar. Maybe another test around that 114 and a quarter, 114.30-ish area, just to set up for another lower high type of area, type of setup as we go into next week. But at this point, it's bearish, and I'm looking at that as such. Last but certainly not least, the British pound. We do have a BOE rate decision on Thursday morning, right in here. Expected to hold rates 375, but if looking for dollar weakness, this has been one of the ones that I've been most attracted to, largely because of the way that it had reacted until that dollar strength had showed up. Like we had this very profuse breakout around that US PPI report the week before last, but you can see it's a decisive sell-off since. Going down to the 4 hour, there's still there's nothing to get bullish about here yet, in my opinion. We've had a continued run of lower lows and lower highs. So far, we have a wiggle up, a test of that lower high resistance from prior support. So this is something that might come to fruition next week, but there's still some pieces that need to come into play before I can make the argument that this is bullish. At this point, all that we have is a stalling near lows around that 133 area. So for next week, early next week at least, if we get a breach of that resistance at 33.43, then I could start to say short term we have some higher highs to go along with that stalled move, and then I can start to look for a higher low, and then something that could advance into that level at like 33.90 for what I'm considering to be a pretty big test. But with what we have right now, I'm going to want to see that level come into play before I start looking for a higher low to work off of to run USD weakness setups, especially if it's ahead of the Fed. But that, my friends, is what I have for next week. Like I said, it's a thick calendar. Be nimble, stay quick. Do not expect any of these things to be easy. I know there's a lot of retail traders that are laying into dollar yen shorts, and that could be a dangerous counter trend backdrop to go off of, because if Katayama wanted to make an intervention threat, I feel like she already would have done so. And we just got to see the way that Wade handles it on Thursday. But that, my friends, is what I have. Thank you for your time, and as always, happy trading, ladies and gentlemen.